Listen, I need you to understand something critical that's happening right now in the gold and silver markets. Tomorrow isn't just another trading day. It's the final bell before everything changes, and most people have absolutely no idea what's coming. Right now, as I'm recording this, we're sitting at a pivotal moment that only happens a few times in a generation. The kind of moment where fortunes are made or lost based on whether you saw it coming or not. And tomorrow's market close is the deadline. Let me paint you a picture of what's actually happening behind the scenes. While everyone's distracted by holiday shopping and year-end festivities, the smart money is making moves that will define the next 12 months. Central banks are positioning, institutional players are hedging, and retail investors? Most of them are completely asleep at the wheel. Here's what you need to understand about market closes at this time of year. They're not just administrative events, they're settlement dates. They're the moment when contracts expire, when positions get marked, when the real players show their cards. And this particular close? It's loaded with more significance than any I've seen in years. Think about what's been building throughout this entire year. We've watched gold climb to levels that would have seemed impossible just a few years ago. We've seen silver wake up from its decades-long slumber. We've witnessed central banks around the world accumulating physical metal at rates that break every historical record. And now we're approaching the final trading day before a major holiday period, when liquidity dries up and volatility explodes. You know what happens when you combine low liquidity with massive institutional positioning? You get price movements that can gap overnight and leave unprepared investors on the wrong side of history. Tomorrow's close determines who's holding the bag and who's holding the gold. Let me take you back to a similar moment. December 1979. Most Americans were worried about gas lines and inflation. The gold market was climbing, but it hadn't exploded yet. Then came the final trading days of the year. Smart money was accumulating. Institutions were positioning. And when the calendar flipped to 1980, gold went from $500 to $850 in just a few weeks. The people who understood the significance of those final trading days made fortunes. The ones who waited, they bought at the top. I'm not saying we're in exactly the same situation, but I am saying the pattern recognition here is impossible to ignore. Look at the setup. We've got inflation that's still running hot despite what the official numbers claim. We've got a Federal Reserve that's trapped between a rock and a hard place. We've got geopolitical tensions that make the Cold War look like a minor disagreement. And we've got central banks that are buying gold like it's going out of style. Actually, let me correct that. They're buying gold like it's coming into style. Because that's exactly what's happening. The Bank of China has been accumulating for 18 straight months. Not occasionally. Not when prices dip. Every single month, like clockwork, they're adding to their reserves. The Polish central bank just announced they're accelerating their gold purchases. Turkey's been buying. India's been buying. Even countries you've never heard of are suddenly very interested in physical gold. Why? What do they know that the average investor doesn't? They know that tomorrow's market close represents the last chance to position before the year-end books get closed and the new game begins. They know that the paper gold market and the physical gold market are diverging in ways that can't be sustained. They know that when you look at the actual supply and demand fundamentals, the current price doesn't make any sense. Let me break down what's really happening in the supply side of this equation. Global gold mine production has been essentially flat for years. We're not finding new major deposits. The easy gold has been mined. What's left requires more energy, more capital, and more time to extract. Meanwhile, demand has been exploding, not just from central banks, from everyone. You've got the jewelry market in Asia that never stopped buying. You've got industrial demand that keeps growing as technology advances. You've got investment demand from people who are finally waking up to the reality that their currency is being debased. And you've got central banks that are diversifying away from dollars at an accelerating pace. When demand outstrips supply in any market, prices rise. That's economics 101. But in the gold market, there's a twist. There's this massive paper market that sits on top of the physical market. Futures contracts, ETFs, derivatives, all of these paper claims on gold that far exceed the actual physical metal available. And here's where tomorrow becomes critical. As we approach year-end, as contracts expire, as positions get settled, someone has to deliver actual metal. Not promises, not paper. Real gold bars sitting in real vaults. And there's growing evidence that the system is running short. Look at what happened at the COMEX recently. Deliverable gold inventories have been dropping. Not gradually, sharply. The registered gold available for delivery is at levels that should be setting off alarm bells. But most people aren't paying attention because they're focused on the price, not the underlying mechanics. The price is what you see on your screen. The mechanics are what determine whether that price is real or just an illusion maintained by paper trading. And tomorrow's close is when reality has a chance to break through the illusion. I want you to think about something. If you owned a gold mining company right now, would you be rushing to sell your product at current prices? Or would you be holding back, waiting for better prices, knowing that demand is strong and supply is tight? Some of the major producers have been doing exactly that. They're not flooding the market. They're being strategic about their sales timing. Now, flip that around. If you're a central bank that needs to accumulate gold for strategic reserves, and you know that supply is tight, and you know that other central banks are competing for the same limited supply, what do? You buy aggressively. You don't wait for dips that might never come. You accumulate while you still can. That's the dynamic that's been building all year. And tomorrow's market close is when a lot of these positions get locked in for the year-end accounting. Here's something most people don't realize about institutional money management. Fund managers get evaluated at year-end. Their performance gets measured. Their bonuses get calculated. Their positions get scrutinized. If you're a fund manager who's been underweight gold and silver while these metals have been climbing, you've got a problem. You've underperformed. And the last trading day before the holiday is your final chance to adjust your positions before the books close. This creates what traders call a window dressing effect. Funds that should have been in gold all year suddenly need to show some exposure. They need to be able to tell their clients, yes, we participated in the gold rally. Even if they're late to the party, they need to show up before the music stops. That buying pressure, concentrated into the final trading sessions, can move markets, especially when liquidity is already thin due to the holidays, especially when the physical market is already tight, especially when other institutional players are trying to do the same thing. You end up with a perfect storm of demand hitting a market that's already stretched, and that's when prices can gap. That's when you wake up after the holiday and the market has moved 5% or 10% and you missed it because you thought you had more time. Let me tell you about a guy I know who learned this lesson the hard way. December 2010. Gold had been climbing all year, but he kept waiting for a pullback to buy. He had his price target. He was disciplined. He was patient. Then came the final trading days before Christmas. Gold pushed higher. He thought it would pull back after the holiday. It didn't. It kept climbing through January, February, March. By the time he finally bought in, he'd missed a $300 move. All because he didn't understand the significance of that year-end positioning. I don't want that to be your story. Now, let me take a quick aside here because this is relevant to a lot of people watching. If you're sitting on retirement accounts, if you've got $100,000 or more in traditional IRAs or 401ks, there's something you should know about. I put together a comprehensive guide on how gold IRAs actually work. It's completely free, links in the description. It walks through the process of getting physical gold into your retirement account without triggering tax penalties. A lot of people don't realize this is even possible, but it's a legitimate strategy that's been around for decades. Worth checking out if you're thinking about protecting your retirement savings with precious metals. Anyway, back to why tomorrow matters so much. The silver market is even more interesting than gold right now, and tomorrow's close has huge implications there too. Silver's been called the poor man's gold, but that's actually selling it short. Silver is an industrial metal that's also a monetary metal. It's used in solar panels, electronics, medical applications, and 1,000 other things you interact with every day. And unlike gold, most of the silver that gets used industrially is gone forever. It's not economically viable to recover it from old electronics and solar panels. So you've got this situation where industrial demand is consuming silver faster than mines can produce it. The above-ground stockpiles that used to exist, they've been drawn down dramatically over the past 2 decades. The silver that governments used to hold in strategic reserves, most of it's been sold off. What's left is in private hands, and those private holders are getting smarter about when and if they sell. The gold-to-silver ratio has been all over the map recently. Historically, it's averaged somewhere around 60 to 1, meaning 60 ounces of silver equals 1 ounce of gold. But we've seen it spike to 80, 90, even over 100 during periods of stress. Right now, we're in a zone where silver looks undervalued relative to gold. And smart money knows this. When you combine undervaluation with tight supply and growing industrial demand, you get a market that's primed for explosive moves. And those moves often happen at inflection points, like year-end, like tomorrow's close. I want you to understand something about how these markets actually trade. During normal market hours, with good liquidity, prices move relatively smoothly. Sure, you get volatility, but it's manageable. But when liquidity dries up, when the big players step away for holidays, when trading volume drops, that's when you can get gaps. Prices that jump from one level to another, with nothing in between. If you're trying to buy after a gap up, you're paying the new higher price. There's no going back to fill the gap. You missed it. And tomorrow's close, followed by a holiday period with reduced trading, is exactly the kind of environment where gaps happen. Now let me talk about something that doesn't get enough attention. The difference between paper metal and physical metal. When you buy a gold ETF, you own shares in a fund that claims to hold gold. When you buy a futures contract, you have a claim on gold that will be delivered in the future, but when you buy physical gold or silver, you own the actual metal. You can hold it, store it, control it. Why does this matter? Because in a crisis, paper promises and physical reality diverge. We saw this during the pandemic. Gold ETFs were trading at one price, while physical gold coins and bars were selling at significant premiums. The paper market said gold was $1,700. The physical market said if you want actual metal delivered to your door, you're paying $1,900 or more. That spread represented the breakdown between paper claims and physical reality. As we head into tomorrow's close, that spread is something to watch. If physical premiums start spiking, it's a sign that the paper market is losing its grip on price discovery. It's a sign that people want real metal, not promises. And it's a sign that the current price structure might not be sustainable. Central banks understand this implicitly. That's why they're not buying ETFs. They're not trading futures. They're taking delivery of physical bars and storing them in their own vaults. They want the real thing, because they know that in a monetary crisis, paper claims become worthless while physical metal retains value. Think about what happened in 2008. The financial system nearly collapsed. Banks that everyone thought were solid turned out to be insolvent. Paper assets that were supposed to be safe turned out to be toxic. And gold held its value. Actually, it increased in value as people fled to safety. The people who owned physical gold could sleep at night. The people who owned paper promises were sweating. We're potentially heading into another period of financial stress. The signs are everywhere if you know where to look. Bank failures earlier this year that got memory holed by the media. Commercial real estate that's imploding. Corporate debt that's rolling over at much higher interest rates. A government that's spending money it doesn't have and can't afford to borrow at current rates. Something's going to break. The question isn't if, it's when. And when it does, the people who position before the break will be fine. The people who wait until after will be scrambling. Tomorrow's market close is your last chance to position before the year-end books close and the new game begins. It's your last chance to get ahead of the institutional money that's going to flood in. It's your last chance to buy before potential gaps and before holiday liquidity dries up. I'm not trying to create false urgency here. I'm trying to make you understand the actual mechanics of what's happening. Markets don't move in straight lines. They move in steps and gaps. And those gaps often happen at inflection points. Year-end is an inflection point. Tomorrow's close is the trigger. Let me give you another historical parallel. December 2015. Gold had been in a bear market for years. Everyone had given up on it. The smart money was quietly accumulating at depressed prices. Then came the year-end close. January 2016 opened with gold starting a rally that would take it up over 30% in the first half of the year. The people who bought in December, who understood that the year-end close marked a turning point, made serious money. The people who waited until the rally was obvious paid much higher prices. I see similar patterns setting up right now. Gold's been consolidating at high levels. Silver's been building a base. Central banks are accumulating. Industrial demand is strong. Supply is tight. And we're approaching a year-end close that could mark the beginning of the next major leg up. You know what's interesting? The mainstream financial media is barely talking about this. They're focused on stocks, on tech companies, on the latest Fed announcement. Gold and silver are afterthoughts in their coverage. And that's actually bullish, because when everyone's paying attention, when gold is on the cover of magazines, that's usually when you're near a top. When nobody's paying attention, when it's boring, that's when the real money gets made. Right now, gold and silver are boring to most people. They're not sexy. They're not exciting. They're just quietly climbing while everyone else is distracted. And tomorrow's close is happening while most people are thinking about holiday plans, not market positioning. That's the opportunity. That's why tomorrow matters. Because you can still act while others are distracted. You can still position while prices are reasonable. You can still get in before the gap. Let me talk about what happens after tomorrow. Markets close for the holiday. Trading volume drops. Liquidity evaporates. And if there's news, if there's a development, if something breaks, the market can't react smoothly. It has to gap when it reopens. That gap could be up or down, but given the setup we're seeing, given the fundamentals, given the positioning, the odds favor a gap up. If you're waiting to buy, if you're thinking you'll catch a dip, if you're assuming you have more time, tomorrow's close is your reality check. After that, you're at the mercy of whatever happens during the holiday period. You're hoping that nothing changes, that no news breaks, that the market stays calm. But hope isn't a strategy. The smart play is to position before the close, to get your exposure locked in while you still can, to not leave yourself vulnerable to gaps and missed opportunities. Now, I know some people are thinking, but what if I buy and the price drops? That's always a risk. Markets can do anything in the short term. But here's what I know. The long-term fundamentals for gold and silver have never been stronger. The supply-demand dynamics have never been more favorable. The monetary environment has never been more supportive, and the geopolitical backdrop has never been more uncertain. In that environment, the risk of not owning gold and silver is greater than the risk of owning them. The risk of missing the move is greater than the risk of a temporary pullback. The risk of being caught on the wrong side of a gap is greater than the risk of buying a day too early. Tomorrow's close is the line in the sand. It's the moment when this year's positioning gets locked in and next year's game begins. It's the moment when you're either in or you're out. And being out, in this environment, with these fundamentals, with this setup, is not where you want to be. I've been watching these markets for decades. I've seen cycles come and go. I've seen bull markets and bear markets. I've seen moments of opportunity and moments of regret. And I'm telling you right now, as we approach tomorrow's close, we're at one of those moments that you'll look back on and either be glad you acted or wish you had. The central banks know it. That's why they're buying. The institutional players know it. That's why they're positioning. The smart money knows it. That's why they're accumulating. The question is, do you know it? And more importantly, are you going to act on it? Tomorrow's market close isn't just another day. It's the culmination of a year's worth of building pressure. It's the release valve for pent-up demand. It's the starting gun for what comes next. And what comes next, based on everything I'm seeing, is going to be significant. You've got one more trading day to position, one more chance to get ahead of the curve, one more opportunity to act before the window closes and the new reality begins. Don't waste it thinking you have more time. Don't waste it waiting for a perfect entry that might never come. Don't waste it being paralyzed by indecision while others are taking action. The gold and silver markets are sending clear signals. The fundamentals are screaming. The technicals are confirming. The institutional behavior is validating. Everything is pointing in the same direction. And tomorrow's close is when you need to be on the right side of that direction. This isn't about fear. It's about recognition. Recognition that we're at a pivotal moment. Recognition that opportunities like this don't come along every day. Recognition that the difference between those who build wealth and those who watch others build wealth often comes down to acting at the right moment. Tomorrow is that moment. Tomorrow's close is that line. After that, you're playing catch-up. After that, you're reacting instead of anticipating. After that, you're paying higher prices for the same metal that you could have bought today. I'm not going to tell you what to do. That's your decision. But I am going to tell you what I'm seeing. And what I'm seeing is a market that's coiled like a spring, ready to release. A market where supply and demand are out of balance. A market where institutional players are positioning aggressively. A market where the final close before the holiday could mark the beginning of something much bigger. You have the information. You understand the dynamics. You see the setup. Now you need to decide. Are you going to act while you still can? Or are you going to wait and hope that you didn't miss the moment? Tomorrow's market close is the most important day because it's the last day. The last day to position before year end. The last day before holiday liquidity dries up. The last day before potential gaps. The last day before the new game begins. Make it count.